Hello, fellow intelligent investors. My name is René Zellman, and in this video I want to discuss a critical component of portfolio management. Because one question I frequently get asked is, how many stocks should I invest in? How many stocks do I need in my portfolio? And admittedly, this is a hugely important question when it comes to portfolio management. And in fact, I think portfolio management may be just as difficult to master as the process of selecting individual companies itself. So what we will do in this video is we will discuss whether there is something like an optimal portfolio size. And we will examine a few groundbreaking studies to narrow down an optimal strategy. So if you are planning to actively invest in individual securities, and if you desire to achieve market outperformance, stay tuned.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Now, before we get started, please let me know in the comment section down below how many stocks you own in your portfolio. What do you think is the optimal portfolio size and why? What are the advantages and disadvantages of running a highly concentrated or a diversified portfolio? I would love to hear your thoughts on this topic. So, I'm sure most of you are familiar with the following adage: don't put all the eggs in one basket. This popular saying describes the basic logic of why diversification makes sense in portfolios. Imagine you actually put all your eggs in one basket and this basket then falls down. You could lose everything. That's why most investors are well versed with the importance of diversification. And even those who have no idea about investing have heard about the importance of diversification. And in my view, the vast majority of people simply accept it as a fundamental investing principle. But in today's video, I want to outline why you should not just accept this idea as a universally accepted truth, at least not when you want to actively invest in carefully chosen companies, and especially if you have ambitions to achieve above average returns. Generally, one can distinguish between two types of diversification. One can diversify between asset classes, and this is called asset diversification, and one can also diversify within the asset class of stocks. This is called company diversification. And we will primarily focus on the latter in this video. But just on a side note maybe, you should understand that diversifying across different asset classes will likely lower your long-term expected returns. Sure, investing in multiple asset classes can be a way to limit portfolio drawdowns in any given year, so it allows you to reduce volatility. However, it will also harm and lower your long-term expected returns because you are basically adding lower yielding assets to a portfolio of high yielding stocks. So that's already all I wanted to say about asset diversification in this video. In terms of being diversified across companies, financial advisors will tell you that one can basically tag every individual stock for various risk factors, such as a market cap, volatility, growth, liquidity, leverage, maybe sector exposure or geographical exposure to certain regions. And quite frankly, if you want to actively invest in individual securities, so individual stocks, it's almost impossible to balance every exposure unless you own more than 100 stocks. It takes hundreds of stocks to create a truly diversified stock portfolio that considers all of these risk factors. So modern portfolio theory suggests to just own a large basket of stocks through mutual funds or ETFs. And just to be clear here, I don't have any problem with ETFs. And in fact, I think it's probably the best way to invest for the vast majority of people. But what modern portfolio theorists miss is that intelligent investors can achieve above average returns by following the investment approach Warren Buffett has basically been preaching for decades. Owning a large basket of stocks can certainly lower your risk according to traditional risk measures. And by traditional measures of risk, I mean beta, or also known as volatility. By diversifying, you are essentially hedging yourself against extreme downs, but also extreme highs. And while this is true, I have two problems with this. First, most financial advisors don't realize that volatility is not risk, and that in fact smart investors should love volatility, because volatility can indeed create great opportunities that provide low risk, high return investments. Secondly, what financial advisors will not necessarily tell you is that if your portfolio is over diversified, you are less likely to outperform the market. And I will back this up with some studies in a second, so please stay tuned. Despite these two problems, broad diversification has become such a broadly accepted good in portfolio management that only very few people actually question whether excessive diversification really benefits investors. And interestingly, this is yet another area where smart and intelligent value investors think academics got it wrong. You can just look at the portfolio of some superstar investors. So we're speaking of the best investors in the world. And what you will realize is that they don't diversify across hundreds of stocks. Just look at the current portfolio of Pat Dorsey, Guy Spear, Alex Ropers, Li Lu, Daniel Loeb, David Einhorn, Howard Marks, or Warren Buffett himself. All of them are concentrated in very few securities, and therefore their record is of course much more volatile. But they are rewarded by exceptional results and exceptional returns. For instance, under Buffett's stewardship, Berkshire Hathaway has outperformed the S&P 500 by a wide margin over the last 5 decades. And as of November 2020, Berkshire's Apple position represents 47.8% of Berkshire's equity portfolio. 47%. That's certainly not something a financial advisor would recommend. Yet, if you would have invested $10,000 at the end of 1964 in Berkshire Hathaway, you would have had more than $247 million at the end of 2019, which represents a compounded annual return of just over 20%. Now, before we move on, I just wanted to let you know that this channel is fairly new. So if you like this video and want to learn more about the art of intelligent investing, the art of valuing businesses, and the art of qualitatively assessing business quality, please consider hitting the subscribe button. Of course, liking the video and sharing it with friends and family would also help me out a great deal and help me reach more people more quickly. So why do these superstar investors ignore the so broadly accepted principle of diversification? Well, let me explain this with probability theory. In probability theory, the so-called law of large numbers says that the more times an experiment is run, the closer the average results will be to the expected result. In investing, the expected result is basically the return of a benchmark index. For instance, you can use the S&P 500 as a benchmark. And the more stocks we have in the portfolio, each stock representing an experiment, the closer the portfolio's return will be to that index, to that benchmark. And as a result, diversified portfolios tend to behave like an index, as they have more names or more companies in them. The more a portfolio resembles an index, the harder it becomes to beat the index. Put in a nutshell, I think it's difficult to look like an index and yet still outperform it. The Dow Jones is actually a pretty good example to illustrate how owning around 30 companies operating in different industries, so basically this represents industry diversification, how owning a basket of 30 stocks is pretty much indistinguishable from owning the entire US market. So what one needs to acknowledge here is that you do not only diversify, a term or pun invented by Peter Lynch, and which basically means that something becomes worse by diversifying. So you do not only diversify your portfolio by including different asset classes, but also by owning too many stocks. When you own fewer stocks, you increase your chances of either underperforming the market, but also of outperforming the market. A financial advisor would argue that a high degree of diversification pretty much guarantees that you can achieve returns that resemble market returns. Since the majority of active investors tend not to beat the market, this is certainly an advantage of a diversified strategy. However, it also limits your upside. Think of it this way. Let's say you have 3 stocks in your portfolio. If one of these stocks doubles and all the others remain flat, your overall portfolio just rose in value by a solid 33%. So the impact of that single stock is quite meaningful. However, if you have a portfolio of 30 stocks, if a single stock doubles, this doesn't really have a meaningful impact on your portfolio's value. But of course, the same could be said about the impact of a losing stock. Overall, this is why diversification is great if your main goal is capital preservation. This might be your goal once you have achieved financial independence. The more money you have, the more important it is to invest widely. At least if you don't want to continue to maximize wealth. The more wealth you have accumulated, the more difficult it becomes to recover potential losses in a reasonable period of time. Once you have lost 30 or 40% of your total capital, it's hard to recover these losses. For example, if you would invest $1,000, then it's maybe not a big deal if you lose it. But by contrast, if you have $10 million, then a total loss would be quite catastrophic. But while diversification is great to preserve your capital, it is not the best way to build wealth. If you know what you are doing, know how to analyze businesses, and know how to estimate the intrinsic value of a company, running a concentrated portfolio, a portfolio that holds a small number of different stocks, increases your odds of beating the market and of achieving your financial goals more quickly. Warren Buffett himself has once famously said that over-diversification may preserve wealth, but concentration builds wealth. Also, what's important to realize is that most fund managers are under many restrictions, and they are required to do certain things which basically limits their ability to outperform the market. They first and foremost try to avoid volatility because investors will withdraw money during downturns, which forces them to sell parts of their portfolio to pay for these withdrawals. As a private investor, your major advantage is that you don't have to worry about volatility. Being able to run a highly concentrated portfolio can give you a massive edge as a private investor, actually. Diversification is certainly not an easy subject, yet it is very important. So let's examine a few studies to narrow down an optimal strategy and to back up the claims that I have made so far in this video. In 1968, John Evans and Stephen Archer of the University of Washington published a paper titled Diversification and the Reduction of Dispersion, an empirical analysis. They were trying to figure out the ideal portfolio size and recognized that no more than 10 to 15 stocks were needed to achieve sufficient diversification. In fact, the benefits of diversification, which is mainly less volatility, dropped off steeply when more than 20 stocks were added to a portfolio. Reilly and Brown came to a similar conclusion in their book Investment Analysis and Portfolio Management, and they argued that in one set of studies for randomly selected stocks, about 90% of the maximum benefit of diversification was derived from portfolios of 12 to 18 stocks, assuming you own an equally weighted portfolio. What I would add here is that obviously the types of companies whose stocks you invest in, the quality of these companies, will also determine how many stocks you must hold to be well diversified. What I want to emphasize here is that the portfolio of a well-versed value investor will not consist of a randomly selected, but rather a very carefully selected group of high-quality businesses that are, in addition to that, available at an attractive price. Ultimately, in my view, skillful investing and carefully choosing moaty businesses, so firms with an impenetrable competitive advantage, these companies can reduce risk more than diversification can. So please do not substitute diversification for analysis and your own judgment. A diversified portfolio of overpriced stocks is much more risky than a portfolio of 3 compounding machines purchased at an attractive price. Alright, let me reference another data point here. Joel Greenblatt found in his book You Can Be a Stock Market Genius that only just 2 stocks can eliminate 46% of non-market risk. Non-market risk, also known as unsystematic risk, is basically company-specific business risk. And this number climbs to 72% with 4 stocks, 81% with 5 stocks, and 93% with a 16-stock portfolio. Basically, Greenblatt, just like the others, illustrated just how quickly most of the benefits of diversification can be achieved. And let me reference one more study here. In The Warren Buffett Way, Author Robert Hagstrom ran an experiment that illustrates the effects of a concentrated portfolio. Hagstrom used a database of 1,200 companies with reliable data, such as earnings, revenues, and return on equity, for the purpose of constructing a hypothetical portfolio. He then looked at 3,000 randomly assembled portfolios, formed 4 groups, and calculated the returns of each portfolio in each group for a 10-year period ending in 1994. Hagstrom then compared the performance of his hypothetical portfolios to the S&P 500. And here's what he found. Of the 3,000 portfolios consisting of 250 stocks, only 63 were able to beat the market. 337 of the 100 stock portfolios managed to beat the market. 549 of the 50 stock portfolios managed to beat the market, and of the 3,015 stock portfolios, 808 were able to generate alpha. So in essence, Hagstrom illustrated that having fewer stocks in your portfolio increases volatility, but it also increases your odds of outperformance. On the flip side, one also has to point out that the more stocks you own, the less likely you are to underperform the market. All right. What's the big takeaway here? Diversification seems to reduce portfolio volatility more than it actually reduces portfolio risk. And there's a major difference between volatility on the one hand and risk on the other hand. So in my view, you should be familiar with the notion that reducing volatility provides only short-term benefits. For a long-term investor with the desire to build wealth, a more practical definition of risk is certainly the risk of a permanent loss of capital. But there's another form of risk, the possibility or probability of not achieving his or her desired returns. Interestingly, diversification does not necessarily reduce this type of risk, but it will likely increase it if you are trying to achieve above average returns. When you are able to find a 10 or a 100 bagger, you want it to matter, right? So you need to run a concentrated portfolio if you want to outperform the market. But what should have become clear is that not everyone wants to outperform the market, and that your financial goals are obviously very personal. Now, portfolio management is certainly a complex topic, and there are many other issues and nuances that I actually would like to address here, but I didn't want to do a 60-minute video. So I will likely discuss these topics in future videos, and I'm actually thinking about doing a little video series here. So in the next video, I will discuss how many stocks I recommend to own, and I will outline a set of questions that you should consider when it comes to choosing the appropriate size for your portfolio. Also, I want to talk about the challenges of running a very diversified portfolio. I want to talk about this in more detail. So we'll likely do 2 more videos on this subject in the next 2 weeks maybe. And of course, if you want to watch these videos, I recommend subscribing to the channel, clicking the bell button so that you are notified when I upload my next videos. And with that being said, I hope I see you in the next video, and may your investments and finances prosper. Good luck.